Have you ever thought about it? There's a room in Washington, D.C. where just 12 people make decisions that directly affect whether you can afford a new car or a house next year. Nope, it's not the White House. We're talking about the Federal Reserve. Today, we're going to pull back the curtain and show you exactly how what happens in that room ends up in your wallet.
Right, that's what I always wonder. Every few weeks, the news just explodes about the Fed meeting. But what are they actually doing in there? Seriously, how does their conversation connect to my mortgage rate, my credit card bill, or even my chances of getting a raise?
So that group is the FOMC, the Federal Open Market Committee. And the best way to get what they do is to think of the entire U.S. economy as this massive, colossal cargo ship. Those 12 people on the FOMC, they're the captains on the bridge. Their whole job is to steer that ship through some really treacherous waters, trying to dodge the huge icebergs of recession and the whirlpools of inflation.
Exactly. And Congress basically handed them a map with only two destinations on it. It's called the dual mandate. Goal number 1, keep as many people working as possible. Goal number 2, keep prices stable, which is just a fancy way of saying keep inflation from going crazy. Now here's the really tricky part. Those two goals are almost always fighting each other. It's like trying to balance a seesaw perfectly. Push down hard on one end to get more jobs, and the other side, prices, can just shoot up into the sky.
Right. So, to steer the ship and balance that seesaw, the captains have a dashboard in front of them. And look, the economy has a million different data points. It's dizzying. But they are absolutely laser-focused on just two main gauges, inflation and employment. If you can understand how they read these two dials, you can pretty much predict their next move. Okay, let's zoom in on that first gauge, inflation. This is where I always get tripped up. I hear about CPI, the Consumer Price Index, all the time. But then I hear the Fed talking about something totally different called PCE. Why can't there just be one number? Aren't prices just, prices?
That's a fantastic question, and it really gets to the heart of how the Fed thinks. So think of CPI as your grocery receipt. It tracks the price of the exact same shopping list every month. Milk, gas, rent, the usuals. But the Fed, they prefer PCE, which stands for Personal Consumption Expenditures. PCE isn't just one receipt, it's more like a satellite photo of the whole country's spending. It sees the big picture. So why trust the satellite photo more than the receipt? Two huge reasons. First is something called substitution. Let's say the price of beef goes through the roof, so you start buying more chicken. CPI just keeps yelling, "Hey, beef is expensive." But PCE is smarter. It sees that you switched to chicken and understands that your actual cost of living didn't jump quite as much. The second reason is scope. PCE includes massive costs that you don't even see, like what your employer pays for your health insurance. It just gives a much fuller, more complete picture of the pressures in the economy.
And for that big picture PCE gauge, there's one magic number, 2%. That is the Fed's target. It's the sweet spot where they feel the economy is humming along nicely without overheating. So if that PCE number starts creeping above 2% for too long, a big, bright red warning light starts flashing on their dashboard.
All right, that's making sense. So gauge number 2, employment. To me, this one seems like a total no-brainer. We want more jobs, right? We want everyone who wants a job to have one. But I keep hearing that the Fed gets nervous when the job market is too good. Why on earth would everyone having a job be a bad thing? Isn't that the whole point?
I know, it sounds completely backwards, but it all comes back to that first gauge we talked about, inflation. See, when unemployment gets really, really low, companies find themselves fighting over a very small number of available workers. So, how do you win that fight? You offer higher wages. But businesses aren't just going to eat that cost. They pass it on to you and me by raising the prices of their stuff. And that kicks off what's called a wage price spiral, where wages and prices just keep pushing each other higher and higher. Suddenly, that inflation gauge on the dashboard is screaming.
Okay, so let's use this cheat sheet and pretend we're in the room with them. Imagine the PCE thermometer is glowing bright red, way over 2%. At the same time, the help wanted sign, that's job creation, is absolutely massive. The captains look at their dashboard and they know they have to hit the brakes. They've got to raise interest rates to cool the whole ship down. Now flip it. If inflation is low, but that pain gauge, the unemployment rate, is ticking up, they know they need to hit the accelerator and cut rates to get the engines going again.
And this isn't just theory. We saw this exact logic play out back in 2022. Inflation was absolutely roaring, but the job market was incredibly strong. So the Fed's thinking was pretty much this. Look, the economy is healthy, Everyone has a job, it can handle some tough medicine. So they decided to make money more expensive by jacking up interest rates to get people to slow down their spending and hopefully bring prices back to earth. And they didn't just talk about it, they really did it. Starting in March 2022, they slammed on the brakes, hard. They kicked off one of the fastest, most aggressive rate hiking cycles in modern history, raising rates a staggering 11 times in just over a year. It was a direct and powerful reaction to those flashing red lights on their dashboard.
So at the end of the day, the Fed is trying to pull off this incredibly difficult maneuver they call a soft landing. They want to slow down that giant economic ship just enough to get inflation under control, but without steering it straight into the rocks of a recession. It's a nail-biting balancing act with just a couple of gauges to guide them. And it really leaves you with the one big question. Can any pilot, no matter how skilled, really avoid all the turbulence and bring this thing in for a perfect landing?